Mellow greetings, everybody. My name is James. I'm from the internet, and today we are going to be talking about Robinhood. Now, we are not going to be talking about the animated fox in the Disney movie or Carrie Eloise in tights acting witty. Not that Robinhood, the financial trading app that has been at the center of all of this madness. And over the last few days, I brought to you the story of Stonk Wars, as well as the sequel, Stonk Wars, The Capitalist Empire Strikes Back. And I've been trying to sort of, get a base level of knowledge of what's going on, because a lot of this is extremely difficult. And it's difficult on purpose. The financial and investment sector is massive, and it's hugely overly complicated, partially because it's developed over the years to find its way through loopholes in legislation, and then again to maximize profit. And as those things change over time, it's just continuously branched out and grown. And now it's just this wild zigzaggy maze that unless you're deep in the financial sector, you can't really understand all of it. So let's take a deeper dive into the story of the Robinhood app, and perhaps more of this will start to make sense. The trading app Robinhood takes from you and gives to the rich. This is an article that appeared in Jacobin 2 weeks ago, before all this madness started. The startup trading app Robinhood invoked Occupy as it promised to fix a rigged financial system, but the firm now faces class action lawsuits for scamming its millions of novice customers, showing that democratizing finance is just a way of finding more people to prey on. So if you watched my Stonk Wars report the other day, I did discuss the fact that over the last decade, the finance sector has managed to lobby hard enough to make it so that apps and trading is available to everybody rather than just people with a brokerage or a firm, because they wanted to have more people to leech money out of and have more dead money floating around that can be pushed around by large capitalists with large piles of capital to leverage businesses, to close and short them and make more profit. It really just makes for more edible fish in the same lake in which there is only one big whale. And for the record, in this analogy, you are not the whale. Market researchers estimate that over 10 million Americans became first-time investors in 2020 amid record volatility. A staggering 6 million of those 10 million chose to invest through Robinhood, the Silicon Valley startup that pioneered commission-free trading back in 2013. The app has been lauded by commentators for its mission to, quote, democratize finance. But as the new year approached, the company found itself in hot water 3 times in just 2 weeks. An auspicious beginning. Most recent is the class action lawsuit filed on December 24th that claims Robinhood offsets the costs of its commission-free trading calling card by reselling stock orders for backdoor fees. A similar charge was settled with the SEC on December 17th, with Robinhood forced to pay out $65 million for misleading customers about its revenue sources and failing to execute trades at quality prices. The SEC found that this latter fault cost users over $34 million, which far exceeded any short-change savings they would have made on commission costs. That's great. Hey, come to us. We have commission-free trading. Those other people, they charge you $1 for a trade. Come here. Trade for free. I mean, we're going to leech $2 to $3 of capital out of you either way, but there's no fees. The heist would have been a scandal even if it had hit America's more capitalized investing class, but Robinhood's clientele is different. The average account holder has a few $1,000s at hand, is around 30 years old, and is more likely than not to be a first-time investor. The app that built its brand around sticking up for the entry-level investor, it turns out, has been picking their pockets in the shadows. Dun, dun, dun. But possibly the most concerning part of the recent flurry came from Massachusetts regulators on December 16th, alleging that Robinhood systematically preys on novice investors. The lawsuit claims the app deploys a gamified interface that pushes users to engage in advanced derivatives trading, short sales, and option calls. Trading in the options market, for instance, is typically considered out of bounds for incoming investors, not out of paternalism, but protectionism. But in the name of individual empowerment, Robinhood has removed almost all barriers to this risky, often leveraged, form of derivatives trading, and its customer base is hooked. In the first 3 months of 2020, Robinhood traders bought and sold options contracts at 88 times the rate of Charles Schwab. For those of you who don't know, Charles Schwab is an enormous brokerage and finance house that has been around for eternity. They are an old school player with ancient old fuck you money. If you don't know what fuck you money is, then you only know rich people, not wealthy people. Number 2, if you got all jazzed up by all this GameStop stuff, or maybe, you were like, hey, I might want to take a few dollars and throw them in some stocks so I can start building up a nest egg for retirement. Well, if you don't understand these words, advanced derivatives trading, short sales, and option calls, if you don't understand any of those words, then Robinhood wants you as a customer. The higher frequency could be attributed to many factors, but Robinhood has undeniably created an ecosystem that rewards frequent and risky trading. It has brought on board young, undercapitalized investors through a social media strategy of variable reward systems, dopamine dependency, and click notification behavioral directives. Virtual confetti, for instance, falls over the user's screen at a first trade, despite the fact that the trade frequently is negatively correlated with trade success. It's literally a finance app with emojis and GIFs. It's like playing Pokemon Go with an Angry Birds overlay, only you're like getting out of work and then pumping your entire fucking paycheck into it. But the problem also runs deeper. Robinhood proclaims that democratizing finance constitutes a social good. Its argument is dependent on a neutral view of markets as a place where the average American can go to turn $1 into $2. In reality, markets are more akin to a NASCAR race. Cheating is common, and over time, the ones who win are those with the institutional backing, high-speed technology, and experience. Still, the average millennial is being told they should enter the track on a bicycle with no helmet. If you have any questions about this sort of behavior, please see any of your friends who are way into cryptocurrency. Hey, this reminds me of a good joke, all right? You ready? A yoga instructor, a vegan, and a cryptocurrency trader all walk into a bar. You know how I know? Because they all fucking told me in the first 10 seconds. So yeah, if you know anybody into crypto, you know this sort of mentality where you're super young, you have very little experience, but you do a bunch of research on one little thing, and then you're just like, here you go, here's all the money I've saved up for the last 5 years to the moon. And that's it. It's all or nothing. This is the white middle class suburban version of getting tattoos on your face and saying there are no days off and there is no plan B. You're either going to be a successful rapper who claws his way out of the bottom, or you're fucking toast. Welcome to End Stage Capitalism. In the SEC lawsuit presented against Robinhood, one of the issues at hand is a practice called payment for order flow. It means that Robinhood is selling your trade to a third-party company for execution. Those secondary brokers will then commonly, quote, take the other side. They are betting that you are wrong. Why? Because they are professionals and you're an idiot with an app who's hoping they get a successful trade so that the emoji pops up and sprays confetti on their screen. Yay! And not only are they betting that you're wrong, they're making double when you are. But even if you win, the brokerage will have made the spread and commission charges from you. It is a zero-stakes game for them and a rigged one for users. One of the more sinister aspects here is that the secondary brokers are lining up, specifically for Robinhood's trade orders. They are paying a huge premium for the right to exploit the app's newcomers by taking the other side of their bets. Increased scrutiny on social media platforms has popularized a phrase that rings true for Robinhood. If you aren't paying for the service, then you are likely the product. It was tech giants like Facebook and Twitter who first revolutionized the neurological genius of the casino. They took the slot machine, made it into a social network. Our own evolutionary desire for community and closeness has been flipped against us. Now there is Robinhood, fusing the most addictive elements of both the casino and the social media apps. But unlike those social media apps, which just make you the product by getting all of your data and then charging their clients a premium to sell extremely targeted ads to you because technically they know you better than anybody else, no, this is different. Robinhood gets all of that, and they also suck your paycheck out of your wallet at the same time. Gotta hand it to them. That's a great double dip grift there. So now that you have a better idea of who Robinhood is and exactly what they do, let's get you up to speed with current events. Robinhood's customers are hedge funds like Citadel. Its users are the product. The Wall Street Bets subreddit are furious after Robinhood stopped allowing trading on GameStop. The secret to Robinhood's success and profitability is simple: payment for order flow. To ensure trades are commission-free, trades are sold to market makers or large firms such as Citadel Securities, Robinhood's largest customer, which tried to bail out Melvin Capital after its GameStop shorts cost it billions. Market makers execute those trades, sometimes at an inferior rate, and can use their privileged position to place themselves in the middle and make a profit. Crucially, in this arrangement, more trades and more volatility mean that there's more firms like Citadel to work with. Market makers like Citadel are supposed to be honest dealers that seek the best price for orders, whether they internalize the order themselves or send it to market. Unfortunately, Citadel has not always done this. In 2017, the SEC fined Citadel $22 million because its algorithms were screwing the retail investors whose order flows it was purchasing. Are you noticing a pattern here? It's almost like capitalists go out and do the shittiest thing they can to extract as much wealth as possible from people who have less capital and less knowledge than themselves. Then, when they invariably get caught, they litigate it down and they pay a small fine that equates 0.5% of their total value or their planned revenue, which means there just aren't like large cheese sticks in the break room in the investing house for like a week. Payment for order flow wasn't invented by Robinhood. That honor belongs to Bernie Madoff. But the company's technique differs from others who use it in the industry in that it charges a percentage of the order spread. In 2020, payment of order flow has made the company a killing. For the first quarter, it accounted for $90 million in revenue for the company. By the second, it doubled to $180 million. Payment for order flow is a wonderful system that makes a lot of money for everyone involved, except for the consumer. Quote, giant Wall Street institutions like Citadel will suicide bomb their own business models to protect the real powers from the consequences of the internal contradictions. When a system approaches a terminal crisis, its institutions will break their own rules to suppress elements that threaten the system's continued viability. That's what's happening here. This specific episode may be over in a week or two, but it's a symptom of something very ominous. Now, if you've been watching stories about this on the news, one of the frequent faux outrage surprise things that financial experts who are guests on all these shows come out and say is, oh, this is an aberration. This is the market working in a way it's not supposed to. This should never have happened. This will never happen again. This happens all the time. If you have any questions, please see what happened the last time somebody tried to overshort a stock like, I don't know, Volkswagen, and its value went up, 9,000% in a day. Yeah, this happens anytime somebody gets caught with their ass hanging out, and then all the financial experts and all the institutions go, oh, this is just an aberration. Don't worry, we're going to investigate it and make sure this sort of thing never happens again. And then they just come up with even more ingenious ways to fuck you while enriching themselves. Lather, rinse, repeat. So, now that the pit boss has come over for the casino masters and, shut down the hot streak to make sure that the house always wins, people are outraged and they're flipping out and they're screaming, and Robinhood is the target of their angst. However, it turns out that being angstful against Robinhood may even make you more of a loser and them more of a winner. Robinhood users who flipped out about restricted trading really should read this. There's been a significant degree of wailing and gnashing of teeth over the popular stock trading platform Robinhood's decision to pause transactions Thursday involving two key stocks. The move was connected to the Reddit community's inflation of the stock price of the retail store GameStop to astronomical levels and its subsequent targeting of the movie theater AMC. Robinhood said its decision was a risk management decision and was not made on the direction of market makers we route to. Like those fine people at Citadel we were just reading about. The move by the private platform should not be a surprise given the site's own user contract, which everyone should have read when they signed up for the service. Quote, restrictions on trading. I understand that Robinhood may, in its discretion, prohibit or restrict the trading of securities or the substitution of securities in any of my accounts. Basically, this is the company's way of saying anytime they have skin in the game and there's a decision to be made whether you're going to lose money or they're going to lose money, well, you lose. Anyone who becomes irate about this would be wise not to sound off against Robinhood. That's because the contract also says, further, Robinhood will not tolerate any foul or abusive language, physical violence, threatening behavior, or other inappropriate conduct directed towards Robinhood, its affiliates, officers, employees, contractors, or customers. If I engage in any such behavior, as determined by Robinhood in its sole discretion, I agree that Robinhood is authorized to liquidate any securities, send me the proceeds, and then shut down my account. Robinhood will not be responsible for any losses caused by the liquidation of those securities. Damn, oh crap. All of these clauses make it rather clear that Robinhood was within its contractual rights to shut down parts of its service. Now, yes, there has already been one class action lawsuit filed. I'm sure there are going to be other lawsuits, more investigations, maybe even some congressional hearings. But it would appear that Robinhood legally protected its ass and did as much as it could to make as much money as it could for its large investors while fucking over the rest of its users. Not very Robinhood, but peak on brand for what appears to be an off-the-rails year. Yeah, 2020 wasn't bad enough. Y'all better buckle up, because we're only like 4 weeks in, and shit is crazy already. Until next time, my name is James. I am from the internet, and I am out. Peace.